All right, so our research team has been doing deep dives again on a lot of these hearings that are going on in Capitol Hill. Obviously, today we're going to be talking about stablecoins and how this may apply to the entire market, the good, the bad, some of the things that are implemented here. We'll do a full clip parade for you guys, break it down for you, make it easy for you to understand not only how this is going to work, but the impact. So it's going to be big. My name is Paul Barron. Welcome back into TechPath. And before we get started, I want to thank our sponsors today, and that, of course, is iTrust Capital. If you're looking at going into long-term crypto holdings, then maybe an IRA is the way to do it. What I always do is look at diversifying your assets in a variety of different ways, whether some is self-custody, maybe a little on exchanges for those quick hit moves, and then you look maybe at things like this, which could be a great place for you guys to, of course, park Bitcoin, ETH, even gold and silver. So just make sure and use our link down below. It will help you out. You can move your current IRAs in there. You can start a new one. All kinds of cool stuff. You get a $100 funding reward if you use our link. All right, so let's get into a couple of points here. I'm going to go over to McHenry. Seems like we're there on his website once a week now. Patrick McHenry's hearing breakdown, and you can kind of see the people that will be involved in this, so you kind of understand. We've got Fenny Wang, who is the founder and CEO of Humanity Cash. Matt Homer, managing member, the Department of XYZ, former executive deputy superintendent of research for the New York Department of Financial Services. David Portilla, partner at a law firm there, and then the CEO of USDF Consortium, Robert Morgan, and then Delicia Reynolds Hand, the director of Financial Fairness, Consumer Reports. So a good group here, I think, in general, to address what's happening within the stablecoin aspect of regulation and where all this might be going into for the future. All right, so let's take a look at the legislation that is attached to this hearing. There's basically two bills we're showing here on screen, obviously, with McHenry being one side of the camp from the Republicans and Maxine Waters' bill coming in from the Dems. So we're going to take a look at both. You'll get a chance to hear kind of the variations, and they're going to basically vote on either or of these two, even though I think a better option would be to combine. But anyway, let's jump over to clips and take a look at what they had to say. Here's Maxine Waters.
The Democratic compromise draft that I posted for today's hearing includes several critical provisions that's missing from the Republican draft. One of them would give the Federal Reserve Board the option to decline any registration of a state-approved stablecoin issuer. This aligns bank and non-bank stablecoins issuers with the current process we have for state-chartered banks and would ensure a strong federal floor for registration. This means that stablecoin issuers could not engage in regulatory arbitrage. Can you elaborate on the importance of giving a federal agency like the Fed a role to approve payment stablecoins before they are issued?
The cryptocurrency and the Fed overlap when banks hold cryptocurrency as an asset on their balance sheets. And in the last couple of years, we've seen that when the traditional banking system and DeFi begin to intersect, it can create significant questions and structural issues. For example, although stablecoins may peg their value to the same real-world asset, stabilization mechanisms vary greatly. So this is one of the reasons why they have the effect, payment stablecoins can impact the monetary system, and why we need a role for the Fed in the same way that there is the role for federal regulators to approve state-chartered banks. There has to be a role for the state, for the Fed to review applications and reject them if they don't meet certain requirements.
Would there still be a significant role for the Federal Reserve to play, and what would that role be under the McHenry proposal?
There would be a significant role for the Federal Reserve to play in that scenario, namely in two ways. The first being backstop supervision. So the Federal Reserve would have access to the books and records of the companies that are regulated by the states, and would have the ability to step in if they felt they were not being properly regulated, and also would be able to take enforcement actions.
Anything specifically we can learn from the Singapore
Sure. I think, we were saying, I think one thing that's important to note is that stablecoins will happen regardless of whether we want them to happen or not. U.S. dollar denominated stablecoins. There's nothing stopping offshore entities from doing this already. We should have it done in the U.S. so we can regulate it on our own terms. We can learn a lot from stablecoin frameworks being proposed in other countries like Singapore and the EU. In some ways, they mirror much of what is reflected in this proposal regarding reserve requirements. I think one feature that is different than you see in other markets is a tiering. Under this proposal, someone who issues $5 of stablecoins is regulated in the same way as someone who issues $5 billion worth of stablecoins. And in other country proposals, we see a tiering in terms of regulatory requirements.
All right, so this kind of goes into, I think, all basic stuff, very reasonable. I think they're asking good questions, from the legislator's standpoint. And the answers are pretty clear and straightforward that, this is going to happen worldwide. I do agree that McHenry's bill does address this kind of multi-tier, much like the EU with MiCA and how they're approaching stablecoins. Let's go over to our next clip, and we'll get to kind of some analysis here in a minute. But let's go to Green and listen in on this one as well.
The system we have, it has some flaws, but it ain't bad. What kind of power are we giving to non-bank financial companies when they can issue stable coins? In a sense, someone might say they're issuing currency of a sort.
And I understand the concerns you have, but don't paint all of us with the same brush, because there are those of us who may be non-bank financial institutions, but we're community organizations, we're grassroots organizations, we support the work of local community banks, and we're doing that work to ensure that the US dollar works harder, and by allowing us an opportunity to also...
Let me intercede. The chairman has been very generous. Thank you, Mr. Chairman.
Mr. Green,
I
thank you.
close with this, Mr. Chairman. I'm a supporter of Ms. Waters' bill. I'm going to do what I can to help us to have a good piece of
I
legislation.
thank the gentleman.
All right, so that was Finney Wong from Humanity Cash that was basically trying to say, hey, don't lump everybody in one. Even though Green has not been super on top of where this is going, I thought that was interesting. He wanted to diversify a little bit, so he got a little bit of that. That was his big claim to fame in the last hearing that we talked about. Let's go to Flood and Torres around state regulation. Listen in.
I want to say this. I'm glad that Ranking Member Waters and the Democrats have come forward with a stablecoin proposal. Over time, states will learn from each other and adopt best practices from their neighbors, reaching consensus on common issues, and ultimately better regulation across the board. The problem with only federal regulation is that it doesn't undergo that natural, iterative process. Instead, you have this top-down approach that might be more difficult to change over time, and that's not a system that fosters innovation. And it's hard to argue that America's financial system, built on this two-tier federal and state approach to regulation of banks, hasn't yielded great results for the United States. In the case of stablecoins, we're talking about something that we may very well have to revisit periodically as blockchain technology and its use cases continue to develop. It's much better to have several state regulators working in this area than just one or two federal regulators who may require an act of Congress to make technical changes. Additionally, it creates opportunities for states to develop specialization. Regulators can establish a reputation as knowledgeable on a particular set of issues. Such a reputation can then become a reason for a business to locate in that state. My hope was to develop precisely that kind of environment in Nebraska when, as a state senator, I wrote and passed the Nebraska Financial Innovation Act.
I think that the state regulatory pathway is absolutely critical for grassroots innovation, without which we would not be able to have true bottom-up diversity and inclusion of our financial system. These grassroots innovators, they're for the community, of the community, by the community, and we should be allowed to experiment and to fail safely.
It would be very hard to imagine a race to the bottom. A federal standard is established, which is basically the New York standard. I mean, it's New York best practices that have been tried and tested and proven would be established as a federal floor.
There's been a suggestion that state regulators cannot be trusted to regulate state-licensed stablecoins without parental supervision from the Federal Reserve. If state regulators can be trusted to regulate state-chartered banks, then why can it not be trusted to have analogous authority with respect to stablecoins? Regulating fractionally reserved banks that take on credit risk strikes me as far more complicated than regulating a fully reserved stablecoin that takes on no credit risk at all. Okay. And let's be crystal clear, state regulators like DFS have been more effective at crypto regulation than the federal government. The SVB collapse happened under the watch of the Federal Reserve. The FTX Ponzi scheme happened under the watch of the federal government. Federal regulators like the SEC spent more time targeting Kim Kardashian than Sam Bankman-Fried. And so the evidence is crystal clear that we've been poorly served by the SEC's regulatory ambulance chasing.
All right, so I agree with Torres. I mean, obviously, his Democratic position is kind of unique in the sense that still abiding by what we have here in the United States, which is a republic, and that is giving the states the power to kind of handle their own domain. And if this, and he is exactly right, if this can already exist today in a much more weakened state of our banking system with fractional reserve banking and all those kind of things, I think this is going to be a good thing in the sense of how it's framed so far. So far, so good. It's looking like they actually know what's happening here. The question is how they're going to apply it into law. Let's go into what our next clip 4. This is going to be Lynch talking a little bit about how this applies to open markets. Listen in.
This really got me. In the absence of a fundamental use case, the value of most crypto assets is driven largely by sentiment, and future expectations, and not by cash flows from providing goods or services outside the crypto asset ecosystem. So is this something that we want to tie to our traditional financial system and give access to Federal Reserve discount window or access to Federal Reserve services?
We shouldn't open up the federal purse, frankly, until industries are proven to be safe and we cut down on rampant fraud and other abuses. We should start first with clear rules of the road and strong protections for consumers. Then once proven, we should add the additional programs that companies are interested in.
And a common refrain heard from critics of crypto in Congress is that crypto has no use case. But it seems to me blockchain enables real-time transactions, stablecoin tokenizes the dollar, and the ability of a tokenized dollar to move at the speed of the blockchain creates a better, cheaper, and faster payment system, which would include the potential for better, cheaper, and faster remittances for the lowest income Americans. Is that a fair assessment?
A very fair assessment, and we're already seeing that happen.
People say, oh, there's a lack of stability. A lot of the same people are working to create a lack of stability. Where are they going to go for banking? Could you speak to the harm that comes with debanking the industry and the damage and, frankly, lack of stability that it's caused?
Yeah, thank you for the question. I think it is something that has been a challenge, that it has become much more difficult for companies in the space to find banking services, even for the most basic of services, to find an account for payroll, for example. I think, unfortunately, what that will lead to are people looking for alternatives that are, in some instances, offshore.
If you can't deposit your cash in America, you're probably going to deposit your cash somewhere, right? So, then they'll point to that and say, see, they're offshore. Well, yeah, you drove them there on purpose, I might add.
All right, so there's a lot to unpack there. I mean, obviously they start off with the sentiment aspect. There's no utility. That, I think, was dispelled by what Torres said. We all know this coming, from our audience here watching our show. If you're brand new to our show, first thing, hit a like button. It helps out in terms of other people trying to learn what is actually happening. But the points I think here that are starting to lure in is that with a stablecoin regulation, this is going to open up a lot of architecture in terms of utility, speed of use, all the different scenarios that could play into holding cash. I think we'll see a lot of business entities go into treasury positions within stablecoins. The question will be, how does it get applied either into the existing banking system, or does it explode the existing exchange system that is out there today, places like Coinbase, Robinhood, Gemini, et cetera, here in the United States? Or do we see some additional companies that start to explode just on the commodity-driven assets like Fidelity, which are Bitcoin, ETH, and USDC, if it does get in fact passed? So lots to break down here. Let's go further into this on, let's go to our next clip. Let's take a look at this one.
We're spending more money than anyone will even lend us. There seems to be a shortage of demand for treasuries. So, given that the most frequent backing for a stable coin, so that it really is fully backed, is treasuries. Mr. Portilla, could you talk to the important linkage that stablecoins would create for demand for U.S. dollar-denominated treasuries?
If stablecoins are required to hold their reserves in high-quality liquid assets, which of course includes short-term treasuries, there would inherently be increased demand for those assets from those issuers. So I think that's right.
There's a common misconception that crypto threatens the status of the dollar as the world's reserve currency, but the experience of stablecoins have shown the exact opposite. The fact that most stablecoins are pegged to the dollar reinforces rather than challenges the reserve status of the US dollar. Mr. Homer, you actually referenced competition when it comes to, my understanding is that in the realm of financial technology, China has largely been outcompeting the United States. The only fintech battleground on which the United States has been outcompeting China has been the domain of digital currency. Stablecoins, dollar stablecoins, have been far more successful than China's failed attempt at a CBDC. Is that a fair assessment?
It is a fair assessment, and that's because that's what people throughout the world want. People want U.S. dollar-denominated stablecoins.
All right, so again, more good news, I think. Interesting thing here is this could have an effect, and I know the Bitcoiners will not like this, this could have a real effect on the de-dollarization not actually happening. What I mean by that is if we implement a regulation that starts to stabilize a digital USDC or whatever it might be within the United States, it's going to create some liquidity windfalls into USDC, which is only going to support the US dollar, which is going to strengthen the US dollar against other international currencies. And when you look at the idea of this being a national security risk, I think the big national security risk here is not being involved in this and allowing the digital yuan to take its place, possibly the digital euro coming in and taking its place in the global economic system. So this is interesting that this is being accelerated so quickly. I'm going to be very intrigued of how they apply this into law and will they rush it through. We'll get into that in a minute. I want to go over to the next clip. This, of course, is our friend, Mr. Sherman. This is going to be a good one.
Gentleman yields back. The gentleman from California, Mr. Sherman, is recognized for 5 minutes.
I'm here to channel Nancy Reagan. Just say no. To crypto and to so-called stablecoins, the biggest oxymoron in the American language. The other way to go here is with the digital dollar. And the reason he opposes that is he wants to have financial privacy. That's right. If you want to be a drug dealer, you need financial privacy. If you want to evade our sanctions laws, you need financial privacy. Finally, there is the use of private wallets. Now, those who talk about fiat currencies will say, hey, I've got a private wallet. You can't put, conveniently, $1 million in this. Federal government doesn't regulate it, but how much money can you put in it? I can't believe I still have an additional 40 seconds.
The gentleman yields back, and the chair reminds all members that there is no loss of prestige by yielding back in less than 5 minutes.
All right, well, I think there is loss of prestige because it simply is the loss of knowledge and the loss of brain power with Mr. Sherman. And the simple fact is that the best criminal usage of money is this thing known as the US dollar. And that's the whole point when you look at what's happening here with where stablecoins could be going. And I think the privacy aspect, it's not even a question of how this plays out. I'm not sure why his position has always been the contrarian here. Maybe there always has to be someone like that in Congress and in these hearings. But His assessment is always wrong, absolutely. No fact basis, no status of understanding where the markets are going, no worry about what the global financial entity is going to look like as a whole. All right, so we're going to go to our next clip. This is one of Mr. Foster. He goes in, and he has not been for this in the past, and I think his interesting point was this idea around where digital ID might be going with it. So he kind of changes his mind here. Listen to how this comes about.
For example, if a person uses Humanity Cash to buy a secret gift for their secret lover, and with no criminal activity involved, can they expect that it will remain anonymous and secret?
Yes, so the blockchain itself doesn't show any personal identifying information, but we can also design systems that preserve the balance between preserving your privacy versus law enforcement needs. So one of the other areas that I've done work in is around digital identity. So you can, for example, have the DMV or a bank issue a digital token that represents like a KYC credential, right?
Sure.
So
Yeah, the so-called mobile ID or digital driver's
right,
license.
and so a wallet can hold that digital identity token to signal that it has been checked. And then therefore you can have safe transactions without needing to actually know who that person is unless there was a compliance reason to reveal the underlying information.
Yeah. And the other members of the committee know that I'm a huge fan of mobile ID as well.
All right, so I think the key here is that there's hope for people to change their mind, and in the fact that where they get new stuff presented to them, they start to learn a little bit more about the blockchain, and it kind of opens their eyes. And I think that's the opportunity that we'll see going forward. With a lot of people, they'll figure out innovation, it's going to grow, and I think it's going to start to open a lot of people's minds. Let's go over to Waters on this last clip, and this is a good point too. Listen in.
When the exchange collapsed, commingle-led customer assets largely vanished and to this day are difficult to recover. Some are unlikely to be recovered at all. However, this is a different experience compared to FTX Japanese customers who were largely made whole because Japan passed strong regulations against the commingling of funds. Unfortunately, only a few months after the FTX collapse, the Republican stablecoin draft allows for the creation of stablecoins but has no oversight of the wallets where they would hold them. Can you describe the importance of customer protections like the complete segregation of customer assets by issuers, exchanges, wallet providers, and other entities? What are the dangers presented by firms commingling customer assets with the firm's own assets?
We saw in the court ruling in Celsius, there's a clear gray area there, and we need clear rules of the road, particularly around custodial wallets. We need segregation of consumer funds in these instances.
A lesson learned, stablecoins should be fully reserved, and those reserves should consist of 100% cash or cash equivalents. Raise your hand if you agree. I imagine all of you agree, but. Lesson learned, stablecoin reserves should be verified not only by self-attestation, but also by a third-party audit. Please raise your hand if you agree. Customers should have the right to immediately redeem a stablecoin on a one-to-one basis. Please raise your hand if you agree. And stablecoin issuers should be prohibited from lending, leveraging, or commingling customer funds. Please raise your hand if you agree.
All right, so there you have it. I think the banks are probably shaking in their boots right now. The reason is because with stablecoins, this will actually level up the game of having a one-to-one liquidity capability, which is not what we have in the current banking system today in fractional reserve banking, which has been involved and evolved over the past several decades. So this, I think, is right now, based on what I'm seeing, hearing, is that it has a really good possibility of getting into a bill that will get approved and then potentially passed and moved maybe into action very quickly. If this occurs, if we get stablecoin regulation, we will see a massive influx in liquidity. We're going to see unbelievable, I think, Wild West in innovation. And we're going to start to see a lot of companies, individuals, high net worth, and even individuals that are in the lower classes of society that need speed, start to play into the values of what stablecoins represent. Other things that are going to play into this, guys, I mean, there's so many innovation points. If you just think about payroll, getting fractional payroll almost by the hour, by the day, QSRs, quick serve restaurants, they would be in this game so quick because that's going to create value in the workforce. This is just one of many ways, plus the speed in just being able to do transactions from a business standpoint, paying vendors. Then you get into the investor community, speed of access. You guys know that because we live that every day. Being in the stablecoin gives us the capability of moving quickly into all these things. If you're brand new, maybe all of this stuff is brand new to you. And hopefully you're going to subscribe to our channel because this is what we talk about a lot here on the show. We break down a lot of these complex ideas and concepts that are happening both on regulation, but also in the projects themselves. So make sure and subscribe. And if you're not in our Diamond Circle, make sure and get in. It's very simple and easy. If you go over to our Substack, I'm going to go and just show you guys our Substack real quick. This is pbn3.substack.com. Of course, if you guys want to reach me, it's out there on Twitter, @Paul Barron. We'll catch you next time right here on TechPath.